In this video, I'm going to show you exactly how I would invest $10,000 into 3 AI stocks right now, and why half of that money is going into one company that could quietly become one of the biggest winners of the entire artificial intelligence boom. You are about to see how to position yourself across the most important layers of AI, from the chips that power it, to the platforms that distribute it, to the infrastructure that scales it. Because the biggest mistake most investors are making right now is chasing hype instead of understanding where real value is being created. The companies we are about to break down are not just participating in AI, they are building the foundation it runs on, the ecosystem it spreads through, and the infrastructure it depends on to grow. Let's start with the most important piece of that puzzle. The first company, and the one getting the largest allocation, is Advanced Micro Devices with ticker symbol AMD. If you strip away all the headlines, all the hype, and all the noise around artificial intelligence, everything comes down to one simple truth. AI does not exist without compute power. Every model, every training run, every inference request, every generative output depends on chips that can process massive amounts of data at high speed and high efficiency. And that is exactly where AMD sits. This is not just a semiconductor company trying to ride an AI wave. This is a company that spent years rebuilding its architecture, competing at the highest level of chip design, and positioning itself to take share in one of the most important markets in technology. Now here is where things get interesting. The AI market is not just growing, it is exploding. Data centers are being restructured around AI workloads. Enterprises are shifting budgets toward machine learning capabilities. Cloud providers are investing billions into infrastructure that can support next-generation computing demands. And all of that requires advanced GPUs and CPUs. AMD is now directly competing in that space with high-performance AI accelerators and data center chips that are designed specifically for these workloads. The key driver here is not just demand, it is positioning. Because in AI infrastructure there are only a handful of companies capable of producing chips at scale with the performance required for modern workloads. That creates a concentrated market where even small share gains can translate into massive revenue growth. Now think about this. If AI adoption continues to expand across industries, and if more companies start building and deploying models internally, the demand for compute will not grow linearly, it will compound. That is why this is not a short-term trade. This is a multi-year infrastructure build-out, and AMD is positioned right in the middle of it. Now let's talk about the business itself. AMD has transformed over the past decade from a struggling chip maker into a serious competitor in both CPUs and GPUs. Its data center segment has become one of its most important growth drivers, fueled by demand for high-performance computing and cloud infrastructure. And now with AI accelerating that demand, this segment is becoming even more critical. Another important factor is product innovation. AMD has been rolling out new generations of chips that are increasingly competitive in performance and efficiency, particularly in data center and AI workloads. This matters because in high-performance computing, even small improvements in efficiency can translate into significant cost savings at scale. And when you are dealing with hyperscale infrastructure, those savings matter. Now let's connect this to the allocation. Why 50%? Because this is the most direct way to invest in the AI boom at the hardware level. This is where the demand originates. Before AI reaches consumers, before it gets integrated into platforms, before it becomes part of everyday applications, it has to be trained, processed, and deployed. And all of that happens on chips. That makes AMD a foundational layer of the entire AI ecosystem. But there is another layer to this: competition. And instead of seeing competition as a negative, you need to understand how it actually creates opportunity. When one company dominates a market, customers start looking for alternatives to reduce dependence, manage costs, and diversify supply chains. That opens the door for strong competitors to gain share. AMD is benefiting from that dynamic. It is not trying to own the entire market. It just needs to capture incremental share in a rapidly expanding space. And when the total market is growing this fast, even incremental gains can drive outsized growth. Now let's talk about financial momentum. AMD has been seeing strong growth in its data center business, which is increasingly driven by AI-related demand. Revenue from this segment has been expanding as cloud providers and enterprises invest in infrastructure to support machine learning workloads. At the same time, the company continues to invest heavily in research and development, ensuring that it remains competitive in a market where innovation cycles are fast and relentless. That investment is critical, because in semiconductors, falling behind technologically can be extremely difficult to recover from. AMD understands that, and it has been executing accordingly. Now here is the key insight most investors miss. AI is not just about software, it is about compute. And compute is expensive, complex, and absolutely necessary. That means companies that provide that compute infrastructure are positioned to capture a significant portion of the value being created. And AMD is one of those companies. Now think about where we are in the cycle. We are still early. Most companies are still experimenting with AI. Most industries are still figuring out how to integrate it. Most infrastructure is still being built, which means the demand for chips is likely to increase, not decrease over time. And that is exactly why this gets the largest allocation. Because it is not just participating in AI, it is powering it. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second stock, and this is where the strategy shifts from pure infrastructure to distribution, monetization, and scale. Because building AI is one thing, making money from AI at a global level is something entirely different. The second company is Alphabet with ticker symbol GOOGL. If AMD is powering the AI revolution behind the scenes, Alphabet is one of the companies bringing it directly into the hands of billions of users. And that distinction matters, because at the end of the day, technology only becomes valuable when it is widely adopted and monetized at scale. Alphabet already has something that most AI companies are still trying to build: distribution, massive, global, deeply embedded distribution across products that people use every single day. Search, video, cloud services, mobile operating systems. These are not niche platforms. These are foundational layers of the internet itself. And now AI is being integrated directly into those layers. This is where the real leverage begins. Because Alphabet does not need to convince people to use its AI. It simply integrates AI into products that already have billions of users. That dramatically lowers the barrier to adoption. Now let's break down why this business matters in the context of AI. First, search. Search is evolving. Instead of just returning links, it is becoming more conversational, more contextual, and more capable of delivering direct answers powered by AI. That changes the user experience, but more importantly, it changes how value is created. If Alphabet successfully integrates AI into search without disrupting its core advertising model, it could enhance engagement while maintaining its dominant monetization engine. That is a powerful combination. Second, cloud. Alphabet's cloud business is one of the fastest growing parts of the company, and AI is becoming a major driver of that growth. Enterprises are increasingly looking for ways to build, train, and deploy AI models, and they need infrastructure, tools, and platforms to do that. Alphabet provides that through its cloud services. This creates a direct monetization path for AI beyond advertising. It turns AI from a feature into a revenue stream. Third, data. This is one of the most important and least talked about advantages. AI models are only as good as the data they are trained on, and Alphabet has access to massive amounts of data across search, video, maps, and user interactions. This data advantage allows it to continuously improve its AI models, making them more accurate, more useful, and more competitive. That creates a feedback loop. Better data leads to better AI. Better AI leads to better user experience. Better user experience leads to more engagement. More engagement leads to more data, and the cycle continues. Now let's talk about financial strength. Alphabet generates enormous cash flow from its core advertising business. This provides the company with the ability to invest heavily in AI research, infrastructure, and product integration without putting pressure on its balance sheet. That is a critical advantage. Many companies in the AI space are still trying to figure out how to fund their growth. Alphabet is already generating the cash needed to invest at scale. This allows it to play both offense and defense at the same time. It can innovate aggressively while protecting its core business. Now let's connect this to the allocation. Why 30%? Because Alphabet represents the monetization layer of AI. It is not just building technology. It is embedding that technology into products that already generate revenue at massive scale. This reduces risk compared to pure infrastructure plays while still providing strong exposure to AI growth. It also provides diversification within the AI theme. You are not just relying on hardware demand. You are gaining exposure to software, platforms, and services that sit closer to the end user. That balance is important. Now here is the part most investors underestimate. AI is not just a new product category. It is a horizontal technology. It touches everything. Search, advertising, productivity tools, cloud computing, content creation. And Alphabet is present across all of those areas. That gives it multiple paths to monetize AI, not just one. Now think about the long term. As AI becomes more integrated into everyday workflows, the companies that control distribution will have a significant advantage because they control how users interact with the technology. Alphabet already has that control, and it is now layering AI on top of it. That is a powerful position to be in, so when you combine all of this, you get a company that is not just participating in AI, but actively shaping how it is adopted, used, and monetized at scale. That is why it earns a 30% allocation. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now we move to the third stock, and this is where the strategy shifts again, because the first position was about foundational infrastructure. The second was about monetization and distribution. The third is about asymmetric upside. This is the smallest allocation in the portfolio, but it carries the highest potential if things go right. The company is CoreWeave with ticker symbol CRWV. This is not a legacy tech giant. This is not a mature platform with decades of dominance. This is a company built specifically for the AI era, and that is exactly what makes it interesting. CoreWeave operates in the AI cloud infrastructure space, providing high-performance computing resources designed specifically for machine learning workloads. Think about what is happening right now. As AI adoption accelerates, companies need access to massive amounts of compute power, not just chips but entire infrastructure stacks that can deploy, manage, and scale AI workloads efficiently. This includes data center capacity, GPU clusters, networking, and software layers that allow developers to train and run models at scale. CoreWeave is focused entirely on that problem. It is not trying to be everything, it is trying to be the best at one thing, providing specialized AI infrastructure. Now here is why that matters. Traditional cloud infrastructure was not originally designed for AI. It was designed for general computing tasks. AI workloads are different. They require higher performance, lower latency, and more efficient scaling across large clusters of compute resources. This creates an opportunity for companies that can build infrastructure specifically optimized for AI. CoreWeave is positioning itself in that niche, and in fast-growing markets, niches can become very valuable. Now let's talk about growth dynamics, because this is where things get aggressive. The demand for AI infrastructure is rising rapidly as more companies build and deploy models. Startups, enterprises, research institutions, all of them need access to compute. And many of them do not want to build their own infrastructure from scratch. They want flexible access to it. That is where cloud-based AI infrastructure providers come in. CoreWeave is benefiting from that shift. It is scaling its infrastructure to meet growing demand, expanding capacity, and positioning itself as a specialized provider in a market that is still in early stages. But with that opportunity comes risk. This is not a stable, slow-growing business. This is a high-growth, capital-intensive company operating in a competitive environment. Execution matters, scaling matters, capital allocation matters, and small missteps can have large impacts. That is why this is a 20% allocation, not because it lacks potential, but because it carries higher uncertainty compared to the other two positions. Now here is the upside case. If AI infrastructure demand continues to accelerate, and if CoreWeave successfully scales its operations while maintaining efficiency, it could capture meaningful market share in a rapidly expanding industry. And in high-growth environments, market share gains can translate into significant valuation expansion. This is where asymmetric returns come from. Limited downside relative to allocation size, but meaningful upside if the thesis plays out. Now let's step back and look at the full portfolio. $10,000, allocated across 3 layers of the AI ecosystem, 50% into AMD, 30% into Alphabet, 20% into CoreWeave. This is not random, this is intentional. AMD represents the compute layer, the hardware foundation that powers AI development and deployment. Alphabet represents the monetization layer, the platforms that bring AI to billions of users and generate revenue from it. CoreWeave represents the infrastructure scaling layer, the specialized systems that allow AI workloads to expand rapidly without companies needing to build everything themselves. Together, these 3 positions create exposure across the full AI value chain, from creation to distribution to scaling. And that diversification matters, because no one knows exactly which part of the AI ecosystem will capture the most value over time. But by positioning across multiple layers, you increase your chances of participating in that growth. Now here is the most important takeaway. AI is not a single trend. It is a multi-layer transformation that will impact nearly every industry. And the biggest winners will not just be the companies building the technology. They will be the ones enabling it, distributing it, and scaling it. That is exactly what this portfolio is designed to capture. Now, here is something to think about. If you had to choose one of these 3 companies to hold for the next 10 years, which one would it be? And which layer of the AI ecosystem do you believe will capture the most long-term value? Drop your thoughts in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.